Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, Wescott's Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, let's take a moment to set the stage for today's discussion. U.S. GDP grew by 6.4% in the first quarter. The vaccination program has us tracking toward herd immunity in the U.S., although that's not the case in many other countries. The Fed maintains accommodative monetary policy, and we have more details on the latest proposed spending bills, both the infrastructure plan and the American Families Plan. Now, in our last webinar, we discussed that while there are growing concerns of inflation, the market seems to have priced that in and is expecting continued recovery for the remainder of the year. How about the potential tax increases being proposed? Have they been priced into the market, or is this simply not of concern right now?
Yeah, I think it's a great point. And the short answer is I don't know if it is fully priced in. So the tax plan, the Made in America tax plan, has a few details. We'll run through those. The first is there's a proposal to increase the corporate tax rate from 21% to 28%, which brings it halfway back to where it was in 2017 when the tax bill was last passed. And the focus of this tax plan is really on large companies and multinationals. So first, large companies that have been paying lower than the average tax are being potentially subject to a 15% what's called book income tax. And that's really designed and may impact 45 of the largest companies in the US. And along the same lines, for companies that are multinational and have foreign operations have been able to pay less tax than those who don't. And there's a proposal out there to really bring a minimum tax on foreign profits of US entities. There are a couple other things in there too, a clean energy initiative, and a more of a focus on ramping up enforcement for tax avoidance. But if this plan were to be implemented, the targets will be larger multinational companies.
Well, it will certainly be an interesting debate in Washington. But if the Made in America tax plan is implemented, what will be the impact on the market?
Yeah, I think we may be seeing a little bit of this potential being priced in, but not fully. And why I say that is because if you look at the S&P 500, which is really dominated by the largest companies, like think Amazon, Microsoft, Google, those may be the targets of the new plan. And if you look at the orange line, while it's up 10% this year, it's not up as much as the rest of the market. And the rest of the market is, in this case, defined by or represented by the S&P 500 equal weight. So what that basically says is that these companies that have dominated the market, and just a little bit of an update, Apple and Microsoft and Amazon have announced fantastic earnings this past year, which is justifying their price dominance in the market. But going forward, if they're subject to higher taxes, this may be a slight negative, and it may be not fully priced in. If those plans of higher taxes were to be implemented, it would just reduce earnings for these companies, making them look more expensive on average. On the other side, though, Caterpillar, which is a company that really benefits from a global economic recovery, also announced, and they're outside those top names, right? But they're really benefiting from a recovery in the market, and actually said they may be struggling to keep up with demand. So that's a good positive thing going on in the global economy, although the tax plan may be a risk to some of the larger, more multinational companies in the US.
Our Wescott portfolios have been performing well, particularly in the first quarter and through April. In what ways has this broader market helped our portfolios?
Yeah, I think it's important because we're not focused only on those top tech names. Obviously, we're much more diversified. And that broader market is a really positive thing for a diversified strategy like what Wescott does for its clients. As an example of that, the balanced portfolio, a 60-40 portfolio, was up nearly 4% in the first quarter, outpacing its benchmark of about 3.1. And that difference is really because of the slight tilting toward more value-oriented, economically sensitive sectors that are leading the way this year. The managers that contributed to our performance this year include DFA, Dodge & Cox, Royce, and others. And they were the ones struggling in that narrow market last year. Well, they're the ones leading the market this year. So I think the final thing I'd say is that Wescott has a range of tax managed strategies, tax smart strategies, and they're really designed to mitigate the impact of capital gains. And while we're not going to focus on the capital gains tax increases in this discussion, that's something for the future and potentially could impact portfolios. And the tax strategies that Wescott manages on behalf of clients are really designed to mitigate the impact of that on returns. So with that, I just want to say thank you again for joining us and for your continued trust in Wescott.
Thank you, Mark. Great update. As always, please don't hesitate to reach out to Mark or your advisor with any questions. Thank you.